Hello everyone and welcome back for another edition of the Money Pros. I'm Oliver Tutz, certified financial planner practitioner and your host for the next half hour as we talk about the issues related to your money. How to make it, how to keep it, and hopefully how to help it grow. Sometimes what we think we know about personal finance turns out to be wrong. We hear things from friends and family, read them on the internet, and even see them on TV. But how do we separate fact from fiction? On today's show, we'll dispel some widely held financial myths as they relate to some very important financial topics: taxes, mortgages, and real estate. With us to discuss tax myths and reality will be our tax pro, Greg Porcaro, CPA and partner with Auclair Porcaro & Associates. But up first, I want to welcome our very own real estate and mortgage expert, Steve Tetzner, Vice President with Homestar Mortgage. Steve, thanks for being with us back on the show.
Glad to be here.
All right, so we actually got going with this myths idea. There's so many financial myths out there, but you and I were talking about one that sort of inspired the whole show, the idea of financial myths, which is, when talking about mortgages, the idea of the myth of APR. Mm-hmm. So what is APR? Why is it a myth? And why is it so important for people to understand the reality behind it?
Well, the APR stands for the annual percentage rate on a loan. The annual percentage rate is supposed to be the effective rate that a borrower is paying to borrow the money. So very often we'll get consumers who will ask me, well, what's the APR on that loan? And I have to explain to them that the APR really isn't relevant. It's not something that you can take from one lender to another to apply to figure out what is the better deal for the loan. The APR is basically taking all the costs associated with obtaining the loan. If there are points, the legal fees, per diem interest, certain things that get factored into it. But it's an imperfect system because the way the government regulated the APR, they were very vague about how the APR should be calculated, exactly what fees go into the APR. So you could have one lender that calculates the APR one way and another that does it a different way. So the very same loan with the same rate and the same fees could actually have different APRs. Where the APR is very good, though, is when you see advertising, when a rate is advertised on the radio or on TV or in print, and you'll see an interest rate that's often what we call a teaser rate, where you might see a 2.5% interest rate, but the APR is 3.1. When you see a huge disparity between the actual note rate and the APR, that's a signal to the consumer that there are probably a lot of fees associated with that loan, so you should be careful. But when you're making an actual comparison between which lender to choose to work with, you have to go a lot deeper than just the APR.
And just so quickly, what are some of the things, if you've got to go deeper than the APR, off the top of your head, what are a couple of things that borrowers should really be looking at beyond that rate?
Well, the most important thing you want to look at is what is the note rate? And that's the rate that is actually costing you to borrow the money. And then what are the fees that are associated? So what is that lender charging for fees? Are there any points associated with the loan? Do they have origination fees? What does that entail? Processing fees, underwriting fees, document preparation. How much do they charge for the appraisal? How much are the legal services associated with that lender? How do they conduct their business? That's probably one of the most important things to look at.
So it's not just about jumping on the phone, calling 10 lenders and asking what's your rate on a 30-year fixed mortgage.
Absolutely not.
Let me move on to another topic now. We've seen the pendulum swing quite a bit from, say, 5-6 years ago, where the joke was anybody could get a loan, I guess, if they had a pulse. The pendulum certainly swung in the other direction with the real estate crisis and things like that. But a lot of people now are under the impression that you need perfect credit to get any kind of real estate loan. Is that true? Very untrue.
Very untrue. I mean, you need fair credit. And then there can be situations that you may have run into a personal situation because of a divorce or a situation because of your health, that we can account for that. And there are compensating factors to credit report. You know, if you have absolutely horrible credit and you just don't pay your bills on time, you're not going to
get a loan.
Probably not.
But if there are extenuating circumstances, lenders are willing to listen to that and you have a chance of getting a loan?
In very many cases, if it's a legitimate excuse, yes. And then it may be a period of time where they may say, well, come back in just 6 months. Show me 6 months that you've paid on time, or 12 months, and we'll give you a mortgage.
So people shouldn't despair if they don't have that 750, 800 credit score.
Absolutely not.
Certainly a loan available potentially for them, particularly if there are extenuating circumstances.
Down to FICO scores probably as low as 600.
Okay. Now, another piece of that is, say 5 or 6 years ago, you could get a mortgage without putting any kind of money down. Mm-hmm. Again, a situation where the pendulum is swung, lenders are looking for more skin in the game. But is it true you need 20% down for a real estate loan?
Actually, there's still first-time homebuyer programs available with no money down. There's VA mortgages available with no money down, USDA mortgages available with no money down, and then there are FHA loans that are available to all buyers up to certain loan amounts that are available with as little as 3.5% down.
So again, don't despair. If you don't have 20% of the purchase price, it doesn't necessarily mean you can't get financing. Last one, and this one kind of piqued my curiosity because when we were talking about it, I didn't really even understand it, so I'm hoping you can clarify things.
Okay.
You get a mortgage from the bank, whatever that bank or lender might be. People are under the impression that they're borrowing money from that bank. If it's, I don't know, Bank America or whatever the lender is. Are you saying that's not actually the case?
In most cases, it isn't. If you're getting a fixed rate mortgage, a conventional fixed rate mortgage, loan amount $417,000 or under, that loan is probably being resold in the secondary market to either Fannie Mae or Freddie Mac. The majority of those loans are held by Fannie and Freddie. Banks cannot hold long-term fixed rates in their portfolio and lend out their own money. They would be exposed to interest rate risk. If you remember back to the late 80s and early 90s, we had all the thrifts that went out of business, and that's what they were doing. They were lending fixed rate money, and then when interest rates went up, the interest rates and the loans that they had in their portfolio were lower than the interest rates they had to pay to their people that were putting money into their savings accounts, so they were upside down.
I'm going to have to hold you there, but no shortage of myths, even some of the ones that I'm susceptible to, I suppose. So if you'd like more information on mortgage and real estate myths we've covered here today, visit our website at foxprovidence.com, click on the Money Pros. Up next, we continue our separating fact from fiction with our tax pro, Greg Porcaro, CPA with Auclair, Porcaro & Associates. So stay with us. We'll be right back after this.
Porcaro, Porcaro & Associates, a Rhode Island full-service accounting and consulting firm, has been serving New England families and their businesses for over 50 years. We have the expertise and the services people need: income and estate tax, accounting and auditing, business valuation and forensics, business consulting, payroll. Porcaro, Porcaro & Associates provides our clients with expert guidance and reliable service. Let our knowledgeable staff help you fine-tune your financial picture today. Porcaro, Porcaro & Associates is located in Warwick, Rhode Island. Call 401-739-9250.
Broker Service Marketing Group was founded in 1972. We've always maintained an excellent reputation. Our customers are those folks that you turn to for financial advice, insurance, banking, all those kind of things that involve your money and the planning for your future. Bottom line, we're a consulting firm. We attack those problems and give your advisors solutions.
Whether you're purchasing your first home or refinancing, Homestar is the recognized leader.
As Rhode Island Housing's #1 participating lender, Homestar is both a broker and underwriter. This allows us to bring you local appraisers with a better understanding of our marketplace and a quicker turnaround of your loan, which puts you in your home faster.
Choosing the right lender could result in thousands of dollars of savings for you. Come and experience the Homestar difference.
You're here right now, but you want to be here. Your kids are here right now, but you want to get them there. As host of the Money Pros and a practicing financial planner for over 15 years, I know that getting where you want to go requires making smart decisions. At Randall Financial Group, we pride ourselves on developing long-term client relationships by providing high-quality financial planning and investment management free from hype and sales pressure. Whatever your financial goals are, Randall Financial Group can help. Call us today for a free, no-obligation consultation. Welcome back to the Money Pros. On today's show, we're dispelling some financial myths. And in no area are there more myths and misconceptions than when it comes to taxes. In fact, we were just talking about some of them on the break. With us now to clear up some of these, our very own tax pro, Greg Porcaro, CPA and partner with Auclair, Porcaro & Associates. Greg, thanks for being back with us on the show.
My pleasure.
All right, let me start with one that's certainly very widely held. This comes up all the time. Does a home office deduction really increase your audit risk? People have gotten very afraid of the home office deduction over the past several years because they think this is true.
It's so persistent. I get this question all the time as soon as I look at a situation and evaluate the potential of a home office deduction being appropriate. The first question I usually get is that going to increase my audit risk? And It doesn't. The bottom line is it doesn't. This matter was resolved by the Supreme Court in 1993. They laid out very specific rules. They're relatively easy to follow. And beginning next year, they even streamlined the process. They came up with a safe harbor home office deduction applicable next year. So it really isn't. As long as you meet the criteria in and of it, that's really the key, then I have no concern at all about using the home office deduction.
And is it fair to say with a lot of these myths that have to do with increasing your audit risk that the methodology that the IRS uses for determining who they're going to audit and who they're not going to audit, it's fairly proprietary. It's not like it's out there in the public sphere exactly what's going to... There's a lot of factors that go into it, I guess, is what I'm trying. And they don't always tell you what those factors are.
In fact,
they don't want you to, right?
They never tell us.
Right. So here's another one, and this is one we were just talking about. A lot of people, particularly business owners, I would imagine, as both you and I are under the impression that canceled checks, credit card statements, things along those lines are valid documentation for deductions. And obviously this would apply to individuals as well. Are those things going to suffice if push comes to shove with the IRS?
In many cases, they will not suffice because all they indicate is that you spent money on something. They do not determine whether that's something that related to that business activity or maybe for individual or rental activity. So it's very important, particularly with credit cards, to keep the receipt so you can prove that the items that were purchased were not for personal use, that they're related to the business activity.
So it's the invoice, it's the credit card printout that you signed, it's whatever the backup is that shows exactly what the expense was, not the fact that you wrote a check or put it on your credit card that's at issue there.
That's correct, and this is particularly important for charitable contributions where you have the extra criteria for certain contributions to get representation from the charitable organization that there was in fact a donation. So just a canceled check and a credit card receipt, even if it's to a school or a church, you have to get something from that school or church that says this was a donation and you received no tangible benefit in exchange for that contribution.
You got to have those receipts. Now, of all the myths we're going to talk about or have talked about, I would say that this is probably the most pervasive. People get a big refund, they think they've hit a home run, they think they've done it exactly right. Tell us why a big refund is not what you're aiming for when you're doing your tax return.
I'll distinguish one thing. For self-employed people, we'll generally build in a little bigger cushion because their income might not be as predictable. So you definitely don't want to be on the other end of that spectrum and owe a substantial amount. But in general, what I find with individuals, particularly who have wages and they have withholding, is at the end of the year, we'll do their return, there'll be a large refund. And then I'll notice they didn't put any money in their 401k or anything significant. And I say to them, most likely, had you realigned your withholding and 401k contribution, your net pay might have been very comparable, and you would have been putting money away for retirement. Yes, you would not get that big check, which ultimately is spent on stuff. I mean, some people look at it as a savings account.
Savings account, sure.
And that's not really the right way to look at it. You have to, as you know, manage your money as you're earning it. And I think the best thing to do is to try to put money in a retirement account if it's available from your employer, and manage your refund to an acceptable level. You definitely don't want to get back a substantial refund if, in fact, you could have used that money more effectively throughout the year.
What people want to focus on is their overall tax liability from year to year, not necessarily how much they over or underpaid from year to year. And I think that's something that people sort of disconnect in their heads.
Absolutely.
Now, let me ask you another one, fairly common. Are minors and the elderly required to file a tax return?
Well, the misconception is sometimes that they're not. I've had a lot of...
That there's some age cutoff.
And there isn't. If you earn money over certain limits, depending on whether you're a minor or an elderly, you have to file an income tax return. And that's just the way it is. So the common scenario is you have a child who otherwise doesn't have any income, but they may have had stock in a portfolio and they sell it. Well, their gross proceeds have to be reported even if there isn't a gain. So we see that situation come up, very frequently. And plus you have the kiddie tax problem, which in some cases creates a tax liability for a child they didn't even realize they were going to have.
Or in the elderly, oftentimes their only income is Social Security, in which case they may not necessarily have to file a return. But you also have a lot of elderly that have retirement income, IRAs, things like that, that are going to make it necessary to file a return.
That's correct. And the way those things blend, Social Security in of itself might not be taxable when you blend them.
But if you have other income, it's going to make it taxable.
Social Security.
All right, we could probably go on with this for an entire show, but we're going to hold you there. To learn more about the reality behind tax myths we've covered today, please visit our website at foxprovidence.com/themoneypros. Coming up next, both Steve and Greg will join me back on the round table, along with Rob Auclair, our financial planning pros. We continue our discussion on financial myths, so stay with us. We'll be right back right after this.
Experience. Cameron & Middleman, a law firm with extensive experience and wide-ranging expertise to meet your needs. Service. We provide the highest quality legal work while maintaining the personalized attention you deserve. Solutions. At Cameron & Middleman, we offer practical, targeted, and creative solutions to your legal issues. Cameron & Middleman, a full-service law firm with the expertise to meet your legal needs.
Porcaro, Porcaro and Associates, a Rhode Island full-service accounting and consulting firm, has been serving New England families and their businesses for over 50 years. We have the expertise and the services people need: income and estate tax, accounting and auditing, business valuation and forensics, business consulting, payroll. Porcaro, Porcaro and Associates provides our clients with expert guidance and reliable service. Let our knowledgeable staff help you fine-tune your financial picture today. Porcaro, Porcaro and Associates is located in Warwick, Rhode Island. Call 401-739-9250.
When Judge Judy speaks,
You know, take out your violin. I got a little one for you.
it doesn't take long for her message to hit home.
You are outrageous to put your family through this.
And if you're not careful, she'll send you an instant message.
Quiet, sit down. Who cares?
The cases get you thinking.
If something doesn't make sense, it's not true.
The topics get you talking.
You are all nuts.
Judge Judy.
Weekdays at 4 on WPRI 12.
Broker Service Marketing Group was founded in 1972. We've always maintained an excellent reputation. Our customers are those folks that you turn to for financial advice, insurance, banking, all those kind of things that involve your money and the planning for your future. Bottom line, we're a consulting firm. We attack those problems and give your advisors solutions.
Welcome back to the Money Pros. Today we're discussing financial myths, particularly those associated with taxes, real estate, and mortgages. Joining us now on the round table are Steve Tetzner, Vice President with Homestar Mortgage, Greg Porcaro, CPA and partner with Porcaro and Associates, and Rob Auclair, Certified Financial Planner Practitioner with Randall Financial Group. And Rob, I'm going to start off with you. Just from a general standpoint, we've been talking primarily about myths as they relate to mortgages and taxes and things like that, but from a broader standpoint of myth versus reality, how often do you find that people are getting in trouble financially because something that they believe actually turns out to be more of a rule of thumb or even a complete fiction altogether? Do you find it very common people are getting in trouble with this stuff?
Well, my job is to make sure they don't fall into those pitfalls.
Sure.
But it does happen sometimes. And you know, what I look at is myths come from or become sensationalized through media today. So, you know, between all the TV, between what's, you know, going on the internet, what happens is everything gets kind of pounded on people, and all of a sudden after a while they'll believe it whether it's true or not. And so a perfect example is go back 5 or 6 years ago when the market's declining. Everyone made it seem like the world was falling apart. Take my money out, throw it in the bank. And what's happened from there is people have now been scared to go back in the market, missed any of that recovery, and now really have kind of hurt themselves in the long run to do that. Now, that's not to say don't get back in the market, but they've missed a big opportunity there. So I think what they need to do now is, you know, when you make a decision, rely more on maybe some fundamental investment skills, or, you know, employ an advisor in that area where you might need some help. So, you know, I think it is media driven in a sense, blow these myths up and make them seem true, and after hearing it over
I think you make a
again.
good point. I think with a lot of these myths, we're looking at things that in some specific circumstance may be true, the media publicizes them, and we have to take responsibility for that. Here we are on TV talking about some of this stuff, but then people expand it to all their situations. It's really all finance is personal. Not every situation applies directly to you. Greg, you know, in the prior segment we were talking about a lot of tax myths, and one that you wanted to make sure we got in, and I think it's important, is getting back to the issue of audits. If you do find yourself in that situation where you're going to be audited by the IRS, which gives me a little shudder even saying those words, is it a good idea to represent yourself? Because some people are under the impression that, you know what, I got nothing to hide, I'm going to go in there and show them what I got. What do you think about that?
It's absolutely the most dangerous thing someone can do, in my opinion, having gone through the trouble of trying to help people once they started that process. Inevitably they're mismatched, so it's like bringing a knife to a gunfight. Even though your return might be fine as far as you know, you're probably not an expert. The individual at the Internal Revenue Service probably has more knowledge than you, and you don't know whether you may not even know you did something wrong. So it's definitely, you need the barrier to support you in this type of a confrontation, and that's exactly what it is. That's how you have to approach it, and particularly if you prepared your own return and you don't really, may not know. you have to have someone to help you evaluate what your issues are and represent you.
And I'm curious on an audit, when you have a client that's being audited, do you even want them there when you're going through the stuff with the IRS? Or do you typically not want them even part of the equation,
never.
right? Because you never know what they're going to say, right?
That's right, and it's an emotional process, so you never know what might come out as a result of the confrontation. So people get nervous when they're talking to an Internal Revenue agent.
Absolutely. All right, Steve, let me shift to you, because in talking again about financial myths, and we want to try to cover as many of them as we can here on the show. One of the big ones that I always think about is the idea of adjustable rate mortgages. Adjustable rate mortgages seem to get a bad rap from different points in time. People are generally fixated, in my experience anyway, and you've got a lot more on the 30-year fixed or maybe 20-year fixed. Are adjustable rate mortgages always a bad idea? I know some people have gotten into trouble with them, but does that make them bad across the board?
Absolutely not. Adjustable rate mortgages have a place. Some of the very safe ones are what we call delayed arms, where it's a 7-1 or a 10-1 arm, which means that the interest rate that you start with is fixed for 7 years or 10 years before it becomes an adjustable. Many people don't even stay in their homes that long. They refinance the mortgage, they pay the mortgage off. So you need to look at what your short-term and long-term expectations are for the home and for the mortgage that you have, and the adjustable could be a way to save a significant amount of interest, and it's not necessary to take a fixed rate loan.
So you're talking about people that are in a transitional phase in their life, where maybe it's their first home, or it's an area that they're not going to be in for long because of relocation or something like that. So you're talking about being able to save a significant amount of money, and if you're under the impression that adjustable rate mortgages are a bad idea, you're going to be paying money you don't necessarily need to pay.
It's also with the jumbo market, especially people who are borrowing loans for like $600,000, $700,000, $800,000. There's sometimes a point to a point and a half difference in the rate between a 7 or 10-1 arm or a jumbo 30-year fixed. That's a significant amount of interest over a 7 or 10-year period. When these
on that size of loan, sure.
Exactly, and you have the people who are borrowing that much typically have the income where they might even be able to pay that loan off in 10 years. So what's the risk?
Greg, let me ask you another question, and this is sort of more conceptual, and there's a lot of different ways we can go with it, but how often do you hear from clients when they say, you know, why is it always the other guy that seems to be getting the advantage of the tax loopholes, the tax breaks, and, you know, sort of I'm the one paying my taxes, nobody else is? Is that, I mean, there could be circumstances where that's true, right? Like a lot of these myths, but is that really the situation?
Well, you know, because of the political environment we're in, people are talking about the whole tax code as if it's one big loophole, and it's clearly not. And you know, when you think about it, the people that are referred to as those who do not pay tax, you know, that alleged 47%, many of them aren't paying tax because of these so-called loopholes. And I hate that word, by the way, because a loophole is really something where someone takes advantage of a statutory configuration that it was not intended for. A mortgage interest deduction is not a loophole. So it's provided for in the Internal Code with limits, so there's no loophole issue. It's the law, period, in the end. And again, most of those people in that group, they might have a home, so they're deducting mortgage interest, property taxes, the education credits helped out a lot of people. It's not that they're not paying taxes because they have no income, it's because the tax code is providing protection by virtue of statutory construction.
And in your experience doing a tax return for anybody, in your experience, do you find that there are people that aren't able to take advantage of any aspect of the tax code? I mean, people generally get some advantage, whether it be the home office deduction or child tax credits or exemptions or whatever it is. It's not like there's a certain class of taxpayer that just doesn't get any help,
The
right?
only thing that would happen is if they do their own income tax return, then maybe they may end up in that situation.
In which case, the only people that have to blame are themselves,
That's right.
Okay. Now, Rob, we're talking about, you know, these myths, but one of the things I'm curious about is we're sort of compiling for the show, or talking to our guests here, is, you know, some of these myths are relatively new, maybe because of change in the economy, the real estate market, things like that. But some of them have been around forever. Why do you think these myths are so pervasive? They hang on despite, you know, a lot of the stuff we're talking about, the real information is readily available. But why do you think the myths hang on so pervasively?
I think two reasons. One is myths tend to have some truth to them, or a part of the myth has the truth to them. And number two is people kind of attach themselves to it. And if they only hear maybe half of the myth, they say, oh, that's me, and I should be doing that. And so I think people need to do is bring it back to an individual level of saying, okay, what's my circumstance? It's almost like saying, there's no cookie cutter or template for someone. Every situation, is going to be a little bit different. Don't attach yourself to that myth. You need to see what's true for me, not just a piece of the myth that you hear, and then you run away with it, and the rest of it's got nothing to do with you.
That's funny that you say that. It almost reminds me, when you hear about medical ailments, and you go, oh, I think I have those symptoms. It's easy to, I think, listen to some of those things and say, that applies to me without actually looking into the background. Yeah. All right, gentlemen, great conversation, and we could go on with this more, but we're going to have to hold it. For more information on money, myths, and reality, visit our website at foxprovidence.com and click on the Money Pros. When we return, our last show on Social Security generated a question from a viewer. After the break, we'll have the answer, so stay with us. We'll be right back right after this here on the Money Pros.
Experience. Cameron & Middleman, a law firm with extensive experience and wide-ranging expertise to meet your needs. Service. We provide the highest quality legal work while maintaining the personalized attention you deserve. Solutions. At Cameron & Middleman, we offer practical, targeted, and creative solutions to your legal issues. Cameron & Middleman, a full-service law firm with the expertise to meet your legal needs.
Terrified how close I was to death.
I had become a master at deception.
She was going to end up pregnant.
What am I supposed to do?
He said there's a possibility that you're not pregnant.
In a world of talk.
People may hear anger in your voice, but I just hear pain.
He's the only one who really listens.
If I can help get this family back on track, are you willing to do that?
Talk has a new leader, Dr. Phil.
Weeknights at 5 on Fox Providence.
You're here right now, but you want to be here. Your kids are here right now, but you want to get them there. As host of the Money Pros and a practicing financial planner for over 15 years, I know that getting where you want to go requires making smart decisions. At Randall Financial Group, we pride ourselves on developing long-term client relationships by providing high-quality financial planning and investment management free from hype and sales pressure. Whatever your financial goals are, Randall Financial Group can help. Call us today for a free, no-obligation consultation.
Whether you're purchasing your first home or refinancing, Homestar is the recognized leader.
As Rhode Island Housing's #1 participating lender, Homestar is both a broker and underwriter. This allows us to bring you local appraisers with a better understanding of our marketplace and a quicker turnaround of your loan, which puts you in your home faster.
Choosing the right lender could result in thousands of dollars of savings for you. Come and experience the Homestar difference.
Welcome back to the Money Pros. A recent show on Social Security generated a viewer question. The viewer asks, my husband and I were married in 1968 and divorced in 1979. He was remarried for 4 years and passed away in 1987. I was on Social Security disability from 1993 until May of this year when I turned 66. Am I eligible for any of his Social Security benefit? Further, does waiting until I turn 70 give me any further benefit even though I'm not working? So Rob, we have you here to answer this question. I think in summary, basically what we're looking at is somebody that hit normal retirement age who was previously married, and they're asking, are they entitled to their previous spouses, any of their Social Security, and is there any advantage to waiting till 70? Can you help clarify some of this for us?
Yeah, so the first thing is she needs to make sure as a ex-spouse that he worked 10 years and that he had enough credits. She was divorced 2 years within, and obviously in that situation she has, and she hasn't remarried until after 60. So if she still hasn't remarried, it sounds like she'll be able to tap into, his benefit that's there.
So she would be eligible potentially for some of his Social Security benefit.
Correct. Now, if you're filing for Social Security for this benefit, make sure you go down with the divorce decree. If you go down to the office to file, and then also you'd want to go down with the death certificate. So when I researched it and took a look at that, those are two of the documents.
All right, that's all the time we've got. That's it for today's show. If you've got a question about your money, let us know by visiting our website at foxprovidence.com/themoneypros and click on Ask the Pros, or hit us up on Facebook. We'll answer your question on the air and send you one of our very own piggy banks. On behalf of my guests today, thanks for watching. I'm Oliver Tutt, and we'll see you again next time right here on the Money Pros.